This is RateSpy TV, your covert source for Canada's hottest mortgage deals, strategies, and market intel.
Welcome everyone, you are watching RateSpy TV. We have one mission and one mission only, to educate, give it to you straight, and help you get a better rate. Now, I'm your not-too-secret agent, Rob McClister, and today's show is made possible by our sponsor, IntelliMortgage, the easiest way to get a mortgage online. It's also made possible by the internet, so thank you, Al Gore. Now let's get to the show. Here is what's happening in mortgage land this week. Spring market has sprung, and while we may get more snow next week, it's not going to cover up the first big rate sale of the season. We'll tell you all about it. The U.S. Federal Reserve is raining on the low-rate parade. We'll show you how its impending rate hike could move Canadian rates. And as the Spy does each and every episode, we'll run down the most appetizing rates of the week. Our lead story is the spring mortgage market, the most wondrous time of the year for mortgage shoppers across the land. Spring market is normally prime time in the mortgage business, and some lenders start the promotions a little early. But with no major rate sales, this year's lead up to spring has been, well, kind of sleepy. That is until now. Meridian Credit Union has concocted a new 1.99% 18-month fixed rate special. Now, 18 months is sort of an oddball term, but it's still the lowest lender advertised rate this side of Lake Ontario. Meridian offers decent features like 20% prepayments and a non-collateral charge, which makes switching lenders cheaper at renewal. Unfortunately, it's also got some strings attached. For one thing, borrowers are required to wear a ballerina costume and stand on their big toe in order to qualify for this mortgage. Actually, I think we might have some bad information there. But you do need to have an Ontario property, close by April 30th, have a home valued under $1 million, be purchasing or renewing your mortgage, and pay your own legal fees to switch to Meridian. And for those wanting to milk your home equity to updo the kitchen or finance junior's university, you can look elsewhere because this rate is not available on refinances. And here's another true story. If you're comparing 1.99% to a longer term, know this. Rates would need to climb just over half a point by fall 2018 for a 5-year fix to save you more interest. So to sum up, Meridian's 1.99% special is the best thing since sliced cheese, which coincidentally is our brand of humor here at Spy TV. But this rate is best suited to one kind of borrower, and that is a financially secure purchaser with at least 20% down and a stomach for potentially higher rates at renewal in fall 2018. Now, Meridian aside, 2017 has been a snooze fest for mortgage promotions. Thanks to recent rule tightening, lenders are protecting their profit margins like Breaking Bad's Tuco protects his crystal meth turf. Now, moreover, the last thing big banks want is a wrist slap from the Department of Finance for pouring kerosene on the housing fire with rate wars. Of course, banks didn't start the fire. It was always burning since rates have been turning, if I recall Billy Joel's lyrics correctly. In any case, do not sit on the edge of your chair waiting for a spring rate war that may never come. In other mortgage news, the U.S. Federal Reserve's Janet Yellen is hinting that a rate hike is almost guaranteed next week, and that is about the only thing coming out of the U.S. government that is not fake news. Interest rate futures imply a 91% chance that the Fed will raise rates next week. So what does that mean to you mortgage shoppers in the Great White North? Well, the Spy put on its research hat to find out. We looked at how Canada's 5-year bond yield reacts after a Fed rate hike. Now remember, the 5-year yield influences fixed mortgage rates here in Canada. And over the last 20 Fed rate hikes, if you look at Canada's 5-year yield a week later, it was typically down about an average of 1.3 basis points. 1 year later, Canada's 5-year yield was generally lower by an average of 9 basis points. So if you speak statisticalese, that's a negative 71% correlation between U.S. rate hikes and Canada's 5-year yield, at least over our sample. Now, the takeaway here is to not get too frazzled about these U.S. rate moves. If history is a guide, this year's Fed hikes won't have a mega impact on Canadian mortgage rates, especially since Canada's economy is essentially in a wheelchair at the moment. And remember this, while the path of least resistance is sideways or up, all it takes is one global crisis, one housing crash, or one big sell-off in oil to take Canadian rates right back near their all-time lows. It's now rate surveillance time. Let's start by wiretapping bond yields. Yields lead fixed mortgage rates like a little pony, and Canada's spunky little 5-year yield has just broken out to a brand new and improved 2-year high. If 5-year yields have the gall to move up another 15 plus basis points, well, the lowest fixed rates will rise a notch as well. Now keep in mind, we're not talking about rates blasting off here, but do keep an eyeball on those yields just the same. If this uptrend continues next week, we could see the lowest fixed rates jump by about 10 basis points or so within a week or two. But with oil selling off this week, that's not a lock by any stretch. Now on the variable rate side of the ledger, floating rates are actually improving, and here's part of the reason why. Get a load of this chart. So basically what you're looking at here is how much more banks have to pay to raise 5-year money compared to the Government of Canada. In the last year, that spread, as trader types call it, has gone downhill like an Italian avalanche. For new borrowers, this improvement in banks' funding costs, in part, has led to the 10 to 20 basis point improvement we've seen in variable rates. But don't drink all the champagne just yet. Rates on derivatives are now implying a 36% chance of a Bank of Canada rate increase before year end. Now, of course, economists are fading those odds. They're calling for rate hikes in 2018. And since economists are always right, 50% of the time, we can breathe easy. At last, the time has come for the stars and dogs segment. And no, we're not talking about stars like Drake and dogs like Lassie. We're talking about mortgage terms. Now, let's start with those red-blooded Canadians who crave long-term security. And who doesn't get soothed by a little rate security? For you folks, the term of choice is likely the 5-year fixed. Now you can dig up insured 5-year fixed rates as low as 2.28% through brokers. But if you don't already have an insured mortgage and you have 20% equity or more, then HSBC's 2.35% 5-year wins first place at the rate pageant. And now that's assuming you won't make any changes to your mortgage for 5 full years. Because if you do break a bank mortgage like HSBC's, the penalties can be brutal, almost as brutal as a bank attacking you in the street with one of those free iPads they give out. Anyways, if you're feeling financially secure and don't mind a little rate risk, a short-term fixed or variable rate could be right up your alley. Now, if you've got 20% equity, Meridian's 1.99% special we talked about earlier is all that in a bag of Cheetos, but it's only offered in Ontario, unfortunately. So our apologies to viewers in Whitehorse, Moose Jaw, etc. Elsewhere, you'll find online brokers with 2-year rates near 2% as well. And if you are financially secure and you need or have an insured mortgage, the SPY shows variable rates as low as 1.66% right now. Now that's cheaper than prime minus 1%. A rate so low it kind of almost seems like a misprint. That brings us to the dogs of the week. It's all the same mutts in the pack this week. The 4-year is a dog, although it's less of a dog than last week thanks to new discounts. The 7-year is a hound, and of course the 10-year is a perennial canine. Now, with these terms, the level of rate security simply does not justify their extra cost. Of course, the SPY always reminds fellow agents that the best term depends on your 5-year plan and risk tolerance. And when going rate shopping, you want to balance the flexibility and upfront savings of a short term with the payment security of a long term. And never pick a term while drinking milk because lactose intolerance can interfere with risk tolerance. So that closes our books for this week. Thanks for keeping us company and tuning in. I'll be back here in 2 weeks with more wholesome rates for the entire family. In the meantime, why settle for a good rate when you can get a great rate? Every basis point counts, so the SPY is going to keep watching out for you.
RateSpy TV is sponsored by IntelliMortgage,
Canada's mortgage rate search engine.